This 500 rupee note, this is real cash. But how about the chocolate bar? It's just some extra sugar for the weight. Together, that's exactly what an option premium looks like. Part real value and part time flavored topping. Hi, I am Pranav VK and welcome back to Stockshaala by Kotak Securities, where we break down even the most technical complex topics into small snackable bites. Today, we are diving into what really makes up the options price, and it's not just numbers. Every option premium that you see is made up of two things. The first one is intrinsic value and the second one is time value. Intrinsic value is nothing but the in-the-money value of the specific option. Whereas time value is what a trader pays for the possibility of movement in price before expiry. Think of this concept like this. Imagine you're buying a chocolate bar, but surprisingly, when you open the chocolate bar, you also find a 500 rupees note inside it. This is exactly how it is. You get 500 rupees, which is real cash, that is the intrinsic value, but you're also paying for the packaging, the brand, as well as the expiry date along with the chocolate. So that is time value. Once the expiry date approaches, this chocolate as well as the wrapper have no real value. But whereas only this 500 rupees will retain its value, and this is called intrinsic value, whereas the time value has decayed. Now let's define the intrinsic value for both a call option as well as put option. Let's head to the whiteboard. Here we have the call option. The formula to identify the intrinsic value of a call option is spot price minus the strike price. Whereas for a put option, the intrinsic value is calculated by strike price minus the spot price. Let's take a quick example. One thing we have to remember is that intrinsic value can never be a negative number. Hence, we take this number as a consideration only if it is positive. If it is not a positive number, then it is considered to be 0 in both call as well as put. Now let's look at an example to understand this better. Let's consider a strike price of 500 and a spot price of 550. In the case of a call option, when we apply the formula, it is going to be spot price, which is 550, minus strike price, which is 500. That's going to be rupees 50. So the intrinsic value of this specific call option is rupees 50. Now considering it for put option, we'll take a strike price of again 500, and this time I'll take a spot price of again 550, and let's put it in this case. Strike price is 500 minus spot price is 550. Since the outcome is going to be a negative number, we will not consider it, and the value is going to be 0, as intrinsic value can never be negative. Now let's talk about the time value in action. As the time passes, the time value melts just like how an ice cube would melt in the sun. Options lose this value rapidly near expiry. That is the reason even in the money options don't move much, because it is already all intrinsic. The closer to expiry, the more your option is going to start behaving like the underlying stock itself. Now let's take a real market example to understand this concept better. Consider taking the call option of HDFC Bank, which is right now trading at a spot price of 1500, and we have taken a strike price of 1480. The expiry is in 2 days, and today's premium is 40. Let's first calculate the intrinsic value of this option. Intrinsic value for a call option is basically given by spot price, which is 1500, minus strike price, which is 1480, that is equal to rupees 20. But as you can see here, we have an additional 40 rupees, additional 20 rupees as the premium, because the total premium is rupees 40, but the intrinsic value is just 20 rupees. The additional 20 rupees that you see is nothing but the time value. Now let's do a quick recap of what we have learned so far. We understood that every option premium is made up of two things. One is the intrinsic value and the other one is time value. Intrinsic value is what you would have got if you exercise the options contract today. But whereas time value is what traders are willing to pay for potential movement in the future. So the more time you have, the more expensive the hope. In the next video, we are going to learn how the premiums vary across different strikes and how to pick the right one. Don't forget to like, share and subscribe. This is Stockshaala by Kotak Securities, and remember, in options, time is literally money. I am Pranav VK signing off, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.